Hey guys, what's up? I'm Erin and welcome back to the channel. For decades, US Treasuries have been the gold standard, the safest place to invest on the planet. But something is shifting. Foreign investors are pulling back, Treasury yields have hit 20-year highs, and headlines are beginning to question something that used to be unthinkable: the US dollar's role as the world's reserve currency. So what's actually happening here? Is this just market noise, or is this a sign of something more serious? Let's dive in with facts and context and take a clear-eyed look at the risks and the reality. Let's start with what we know. Foreign demand for US Treasuries is slipping. At the May 2025 30-year bond auction, foreign participation rates were the lowest levels since 2019, and as a result, yields are spiking. The 30-year Treasury recently hit 5.15%, the highest in nearly 2 decades. This signals investors' nervousness, and they're demanding higher returns. Moody recently downgraded the U.S. credit rating from AAA to AA1, citing concerns over rising debt and unsustainable interest payments. The US dollar index is down over 5% year to date, and that's showing a wavering confidence in the US dollar. And for the first time in modern history, the US is paying more on interest payments than they are on national defense. These are not normal patterns. This is different, and it's worth paying attention to. So why is this happening? First and foremost, financial concerns. The US national debt has surpassed $36 trillion. Deficits are continuing to increase with tax cuts and increased spending, and some forecasts are saying that we're going to hit a debt to GDP ratio of 200% by 2055. This isn't just a big number, this has very serious macroeconomic concerns. Research by economists Carmen Reinhart and Kenneth Rogoff famously suggest that once a nation's debt reaches very high levels, like 150% or more, long-term growth tends to slow and the risks really begin to compound. Interest repayments tend to consume more of the nation's budget, investor confidence tends to become a little bit more fragile, and the government's ability to respond to economic shocks becomes a little bit more limited. While the U.S. still benefits from reserve currency status and deep capital markets, climbing toward 200% would place it in a rare and precarious fiscal territory, especially given its reliance on foreign investment. Some may point to Japan, whose debt to GDP ratio has long been above 200%, but that situation is different because the vast majority of Japan's debt is held domestically by their own institutions and their own investors. On the other hand, the U.S. is far more dependent on foreign investors to fund borrowing, and this creates more very real risks if confidence in the system erodes. We're also seeing an interest rate shift. Higher for longer interest rates means that the government's cost to borrow is increasing. Investors want to be compensated for taking on greater risk, so they demand higher yields, but there's more behind the numbers. In the past, historically low interest rates masked the true cost of debt. Now that rates are elevated and expected to remain that way, we're seeing what's being called the financial illusion break. That illusion made deficits seem manageable when debt was cheap. But today, each additional dollar of debt is more expensive to service, and that's compounding quickly. And this has ripple effects. The U.S. Treasury has to roll over current debt when it comes due to new higher rates. And this really constrains spending. It reduces flexibility and it leaves less room for economic stimulus and economic emergency relief. And the longer this goes on, the more painful it becomes, especially if it starts to slow economic growth. Also, global trust is eroding. The U.S. still dominates global markets, but international investors are starting to hedge their bets. With rising political polarization, repeated debt ceiling standoffs, ballooning deficits, a lot of people are starting to ask how dependable is the U.S. as a borrower. We're not seeing a mass exodus, but we are starting to see a strategic reallocation. Foreign buyers are easing off long-term treasury auctions, while some nations are boosting reserves in other currencies. Others are boosting exposure to sovereign bonds with more fiscally stable nations like Germany or Australia, even if the yields are lower. The message is subtle but clear. The US fiscal reliability is no longer accepted as 100% guaranteed. It may not be a dramatic shift, it may not be overnight, but long term we're noticing that the cash flows in the global markets is taking a different course. Why does this matter to everyday investors? What does this mean for you? First, increasing treasury yields drives up borrowing costs. That affects mortgage rates, auto loans, credit cards. So this is going to be really impactful if you're considering buying a home or refinancing. Second, as the government spends more than ever to service debt, this leaves less room in the budget for other things like education, infrastructure, healthcare. The government's spending on interest repayments servicing this debt now eats up a larger piece of the pie. Third, if you're holding long-term bonds in your portfolio, these bond prices are falling as yields rise. Why is that? Because existing bonds with lower interest payments become less attractive as new bonds are issued with higher interest guarantees. Let's say you're a retiree with $500,000 in long-term bonds. If interest rates increase from 3% to 5%, the market value for those bonds could drop anywhere from 15 to 20%, even if the income stays steady. That's real pain if you need to sell or rebalance. Fourth, if confidence in the dollar continues to decline, that adds inflationary pressure, and a weaker dollar means it costs more to import goods, everything from electronics to clothing to cosmetics, and this cost gets passed on to the US consumer in the form of higher prices. But there is one upside. Recent history has given savers and cash holders meaningful returns on their cash holdings. High-yield savings account, money market funds, and short-term treasuries are offering rates in the ballpark of 4 or 5%, and these rates are much more attractive than the near-zero rates that were offered around 2008 or so. If you're holding cash, you're finally being paid to wait, and if you're at or near retirement, it can be really appealing to have such an attractive return on your cash holdings. But here's the key. It's not just about the interest rate. It's about how it stacks up against inflation. That's called your real return. If you're earning 5% and inflation is 3.5%, your real return is 1.5%. But if inflation increases to 6%, that same 5% yield actually loses ground. Your money buys less over time. So yes, rising interest rates can help offset inflation, but only if earnings outpace the increased cost of living. This isn't just policy talk. These changes ripple through everyday life, from how much your portfolio is worth, to what you can afford, to whether you feel financially secure. And depending on how you're positioned, they can either hurt or help your financial future. Now let's be fair. There are strong counterpoints to much of this. Number one, US Treasuries are still the world's safest assets. Central banks and sovereign funds and pensions hold trillions of dollars of US debt for a reason. Its flexibility, legal protection, and sheer size make it hard to beat. The dollar's weakness is relative and cyclical. The dollar index does typically move throughout the course of the year, and 5 to 10% movements aren't uncommon, so what we're seeing now might be just a correction. Foreign selling doesn't mean abandonment. Many investors may just be shifting from long bonds to shorter ones. Others are facing high hedging costs due to rate differentials. That's a technical issue, not a crisis of faith. Rising yields can attract buyers. A 5% yield is very attractive for institutions looking for safe income. The US fiscal picture isn't new. The risks are very real, but they're also priced in, and the US still has the largest GDP in the world. So is this the end of the world's trust in US bonds? No, but it should serve as a wake-up call. Foreign buyers are pulling back. Interest payments are soaring. For the first time in decades, people are starting to ask, what if the world stops giving the US a blank check? It's more than about just the dollar. It's about fiscal credibility. And will US leaders rise to the challenge? So the rules of the game may be changing. And I have a question for you. Do you still consider the US the safest place for global currency? Share your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. From AAA to AA1. I don't even know if that's how you say it. I've only read it. For decades, you have treasuries. You have. I don't even know where that comes from. But something is shifting. The US dollar index is down over 5% year to date. I don't know. The long-term cash flows globally are differentiating. So, oh my gosh. Is it like double A1? Is it like A1 sauce? I almost said AA1 and like, oh my gosh, I would be slaughtered.